Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. Want to talk about an article, comes out from Reuters, basically says US mortgage interest rates jumped to 7.16%, highest since 2001. So I'll leave the link in the description for you to read up on this. So we're seeing that pain is still in the markets. We're still seeing mortgage rates are high. We're seeing that rates are elevated. We had the Bank of Canada that came out, basically did a dovish rate hike where they did 50 basis points. But I'm not surprised because they did do a strong rate hike of 100 basis points before, then a 75, and they were expected to do a 75 basis point rate hike, but they went with the 50 basis point. And they still said that they're still going to tighten the markets, and so it was a little bit of a dovish rate hike in the beginning, and it could signal towards some sort of again pivot like we've been hearing in the U.S. Now in the U.S. they're expected to raise rates also by 75 basis points in November, and then December maybe 50 or 75, and then slow it down afterwards. Maybe do 25, maybe stop raising rates completely. We'll see what happens when the new CPI inflation reports come out. Now, the problem is, right? Why have we been seeing mortgage rates move up? Why have we been seeing rates move up? And it's because we've been seeing the central bank, the Federal Reserve, increase rates aggressively this year at a very, very fast pace. And this is what's causing a lot of the loans, a lot of the rates, a lot of mortgages, especially the 30-year bond. When you see the 30-year US bond continue to sell off, those yields move up, and we start to see rates move up, mortgage rates move up, and so on. Now, the problem that I see with all of this is it's definitely going to put an effect on demand, especially on housing. Now, housing's a little bit tricky one for me because housing's considered a inflation hedge. When there's inflation, housing should do well. And now we're in a tough situation because yes, housing is an inflation hedge. However, mortgage rates have reached to high levels to highs of 2001, and how can someone really go out in the market, purchase homes or couple of homes, a new home buyer coming into the market, how can they purchase it when mortgage rates are around 7.1%, maybe even more for others who can't qualify for a mortgage, or they may have to go for a B or C lender and so on, and they can't qualify from a bank, right? So definitely that dampens demand. Definitely we have seen sales drop in terms of housing, and when we look at the housing numbers. And we're starting to see a slowdown in housing. Now, the only question is, will we see this exacerbate, right? Will we see the fact that mortgage rates continue to go up or stay elevated? And if they continue to go up, why would they continue to go up? It would be because, inflation's not softening. Then sure, we will see mortgage rates still continue. Now, if inflation is not softening, mortgage rates continue to go up. That's not the only problem that will affect a lot of consumers. That means also food, shelter, energy costs, these essentials are becoming more costly, which means that now you have to think what you have to do in terms of trimming your cost. What will you trim, right? And if you have or own a luxury house, you own a cottage or something, and those payments are hurting you because it's costing a lot to put fuel in your car, it's costing you to eat, costing you more to eat, then definitely you could see a lot of sellers come into the market and sell their properties or sell their extra properties that they may have, and just to get rid of it because they're feeling the pinch. Now that's one argument that some people see. The other argument that others see is that if we start to see a slowdown, then a lot of sellers that may come into the market may pull back their house and keep it off the market for some time until they feel comfortable to list it back. And there are people like that, hey, I don't care. I'm going to sit on my house for on the next, 10, 20, 30 years, and I don't need to sell it no matter what the market does. And then you got some people that do feel the pinch of all of this, right? So where does housing lead to in this scenario? Where do we go? Well, it's going to be very hard for me to answer that. We'll know until the time comes. Definitely, this is not a 2008 kind of scenario where, we had these toxic mortgage-backed securities that caused this basically bubble to burst. Definitely inflation is a bubble, and definitely we're seeing high inflation levels and rates moving up to aggressive levels that we have never seen before in a very long time, since the 1980s. Now, on top of that, what I would want to watch for is the unemployment rate and the job losses, especially in the housing sector, construction sector. A lot of these construction companies that are building houses start to see massive layoffs from there and a slowdown in building houses. Probably that will also affect the housing market as well. Now, if you think about it, if you take out less houses, less builders building houses, and you have sellers coming off the market, then you could argue that, okay, there's a supply shortage, so the prices should move up or at least stay elevated. That's one argument. The other argument is that no, people will actually sell because they're feeling the pinch because of the high inflation, and the demand side will be heavily crushed. That will bring prices down and cause panic selling for a lot of these maybe high-priced houses or areas that have moved up quite a bit. And I think it's going to be subjective because it's going to be dependent on the state, the city, the country you live in. Certain areas may have seen a huge increase in prices versus other areas, and probably the high luxury houses, the high price houses, will probably see or maybe see an effect in their prices or turnaround there versus maybe other houses that haven't, right? So there's a lot that you can look at from here, but definitely in news like this where you're getting Reuters talking about that mortgage rates are at high levels in 2001 is not good for the economy, not good for the markets. And if this continues to persist, I'm worried that if this continues, does that mean the Fed needs to hike rates? If inflation's not solving on its own, they need to be more aggressive, which means what? The 30-year bond will continue to sell off harder, which will push the yields up higher, which will also push those mortgage rates even higher. Sure, could see that scenario there. Or, the scenario of the pivot that's coming. If we have the pivot, what does that mean in terms of mortgage rates? Sure, you could see it somewhat come off. If we start cutting rates, definitely we will see, rates come down a bit. But if we start cutting rates now and nothing has, there's nothing that has broken yet, and we start cutting rates all of a sudden, what are we cutting rates for? Just because the stock market's crying for it? I mean, the stock market, when I look at the stock market, hasn't been that bad in terms of a real panic sell-off. This is not what real panic sell-off looks like. This is just an orderly sell-off. If you think this is a real panic sell-off, it's not. Real panic sell-off will look very different than what this is. So if we're cutting rates early, then that should be priced in to the long end of the bond curve, where we'll see yields move up there because they will start to price in higher inflation to come if we start cutting rates now and nothing has broken. Or nothing broke yet. And if that happens, then guess what? The mortgage rates may even move up higher in maybe when we start cutting rates because of the long end bond curve pricing in higher inflation. Or they may, instead of maybe moving up, they may be elevated because you're getting a steepening in the yield curve, and you're getting more of these market participants selling the 30-year, maybe buying the 2-year, and causing the curve to go from inversion to steepening. And that could be your trigger point that, hey, the steepening is not good for the markets, not good for housing, not good for the economy, and definitely that will probably bring in the real crash or the real dump. So I don't know. We'll see what happens with housing. It's a very tricky one. Definitely, these high rates are not good for the economy, not good for how asset prices are at currently. I do still see downside to come. In terms of housing, we will see what happens, and especially depending on where you live. Let me know where you live, the city, the country. Let me know what you think about housing in your area, the rates there. Do you think housing is going to see much of a drop? Leave a comment below. Hit the subscribe button, hit the like button as well, and the bell icon to be notified on the next video. All right, see you guys around. Thanks, cheers, bye.